I hope you've all enjoyed the time away from markets and got very merry. My name is Josh, and I'm Blackfinch's product specialist for our listed investment solutions. And I'm joined today by Gareth Deacon, head of multi-asset investment.
Morning, everyone, and Happy New Year. Good to see you all.
And we'll look to follow our usual structure today, meaning I'll do a quick review of the key events for the month, and then I'll pass the baton over to Gareth, who's going to give us some colour on the key considerations and the outlook for January. And as always, please feel free to use the Q&A box at the bottom of your screens, and we'll try to answer them if we have time. If not, don't worry, we'll reach out after today's webinar to address them. So on to December. And of course, you know exactly where I'm going to go first, and that's inflation and interest rate decisions. There was good news on the inflation front for the UK, as the annual inflation rate is measured by the Consumer Prices Index fell to 3.9% from 4.6% in the 12 months of October. And this marked the lowest point since 2021, and analysts had expected a reading of 4.4%. And this was a great beat for expectations and gave investors a bit of a festive cheer for the holidays, as the FTSE 100 and the 250 rose 3.85 and 8.2% respectively over the month. And in terms of policymakers and their activity, the European Central Bank, the Bank of England, and the Federal Reserve all announced they're holding rates steady, and this is for the third consecutive month now. It's of course a sign there is still some lingering concerns over inflation. However, we saw the US market rally sharply as the Federal Reserve signaled in the mid-December meeting that it was open to lowering rates at some point this year. And it was a very dovish tone from Fed Chair Jerome Powell. And thinking more broadly, we're seeing some gaps open up on how different central banks are thinking about the world, and then the natural knock-on effects this can have. If we start in the US, mentioning the Fed, they didn't explicitly say in December that rate cuts were definitely coming this year at the time, but they hinted pretty heavily that they were. US stocks had one of their biggest advances of the week at the time of the meeting. Officials left rates unchanged as expected, but what was more important was the quarterly dot plot. And this was it essentially summarizes individual policymakers' rate expectations, and they indicated that the median projection was for 75 basis points of rate cuts in 2024, up from 50 of easing in the previous projection. And this, coupled with that dovish tone from Fed Chair Jerome Powell, didn't stop futures markets pricing in a more aggressive cuts this year. And actually, the fact that we've put this webinar forward a week has helped understand the situation a little better. US inflation in the Fed meeting caused very big inflows of capital into US stocks for years, actually. But now we're seeing pretty powerful price action that markets might have gotten a little bit ahead of themselves somewhat. And some of the officials have almost backtracked on what they've said. And what has really come through in the jobs data is we saw a tightness in the labour market. The December jobs report, with the main part covering US non-farm payrolls, was a bit of a wake-up call for financial markets, where expectations of that early Fed rate cut this year had been building up, but now it's not going to happen as investors thought or so quickly, particularly if that job market remains so resilient. Wages ticked up, unemployment still at historical lows, and all of that is indicating hot labour conditions. And that's not really what the Fed wants to see. So there's still some way to go on that. A flip over to the other side of the Atlantic, you've got the European Central Bank. They're really not towing the line with the States, and there's no discussion of rate cuts as of yet. Very similar with the Bank of England. There's still a way to go until they're comfortable with where inflation is. And do bear in mind that all three are in different economic positions somewhat, and most economists are seeing the US as a little bit ahead of Europe in terms of its position in the current cycle. But the Fed's the biggie really that investors watch closely. I mean, of course, the ECB and the Bank of England are a factor, but really it's kind of what the Fed says goes. So off the back of all these events, we saw a significant jump in government bond prices in December globally, and that's pulling yields down very hard. So, you know, if you've got a floating rate mortgage, or you're a company that's borrowed on a floating rate basis, then happy days, because in a lot of the cases, you're paying back the debt every month that could fall as the months go on over the year. And in terms of other market returns, the smaller cap end of the market climbed higher in December. We saw the Russell 2000 index jump nearly 11.5% in December alone. and a number of other indices were at record highs. And the hope is now that investors don't have to clutch on this tiny portion of Magnificent Seven that are AI flavored stocks. And it really has been a big festive present for investors in December. The week in January that I've mentioned, that recent sell-off is a bit of a concern that many company valuations are slightly frothy. They're trading on very high multiples, which has a potential to correct. And that would really correlate with a hard landing scenario or more impactful recession. And just a final point on the topic of company performance, insolvencies are really becoming a much more prominent issue. In advanced economies alone, we're seeing double-digit growth in this metric. If we look at the US, for example, they rose 30% year on year to December. And of course, as you'd expect, it's higher interest rates being the main culprit of that to fight inflation. And we could see this continue moving forward as we're running through that higher for longer interest rate scenario. So certainly a trend to keep an eye on. But I'll pause there, Gareth, and I'll let you tackle the forward-looking points.
Thanks very much, Josh. Just a couple of things, key things to discuss and to think about when we look at 2024. Periods of transition in markets, in politics, in global events often raise some very interesting questions. And I think what we can say right now, 2024 is definitely going to be a period of significant transition. We've got plenty of questions coming up. Will Western central banks finally start cutting rates? Will geopolitical tensions calm or escalate over the next 12 months? What is the US election going to look like when it comes around in 2024? Is Donald Trump's name going to be on the ballot, or is it going to be off? Is it name going to be on the ballot and he's going to be sat in a jail cell? But there's a lot coming up that we need to digest and think about, and this does present some opportunities, but also what it brings to the table is potentially some unknown risks at this point. So cautious optimism is probably the best way to look at it when we talk about 2024. The global economy is slowing, and there's no getting away from that. This is essentially what the central banks wanted when they started raising interest rates. But at the moment, it seems to remain resilient enough to avoid the hard landing. And as Josh has already talked about, December was the situation where markets seem to be pricing in this Goldilocks scenario, this powerful reflation trade that came across asset markets in December, pricing perfection of essentially inflation is going to come down, the economy is going to stay strong, and everything's going to be fine. That very much feels like it was too ahead of itself. We have to consider that certainly in the last few days of December, if not a little bit longer than that, market dynamics do slightly distort pricing towards the end of December. Markets trade on much lower volumes, so moves get exacerbated, and I think that's one of the things that we saw in December. Let's talk about this very clearly. So if you look at some of the equity market returns that we saw in December, it's what some people were forecasting for the entire of 2023, and we saw it in a few days or a few weeks. So we need to make sure that we're not getting carried away with ourselves and thinking everything is as good as markets were pricing by the end of December. We have to be cautious, and one of the reasons for that is that one of the things that's supporting particularly the US economy was the consumer. And we we heard after the pandemic all this pent-up savings that the consumer was going to drive economic growth in the US. We saw savings at a peak of $1.8 trillion in mid-2021. By October last year, that came down to just 337 billion. The majority of that concentrated at the wealthy end of the market. Inflation's dwindled, the savings across a large percentage of the population, and that should lead to services consumption moderating. And more proof of this is that we saw a larger than usual jump in credit card usage in the US in consumer credit growth in November. Proving that people don't have that excess pent-up savings. Let's just talk a little bit about the way in which markets are pricing those interest rate cut expectations. Josh touched on it already with the dot plot from that December Fed meeting, looking a little bit more dovish than September, but nowhere near as dovish as the market is pricing in. The market is pricing in 6 interest rate cuts in the US next year. The Fed is suggesting in the dot plot that you're going to see 3. The dot plot says 3 in 2024, 4 in 2025, and 3 in 2026. The question is, what is going to cause the Fed to cut more aggressively than everyone's expecting, or more aggressively than they are expecting? It's got to be some form of economic downturn caused by a policy misstep. And so it's almost a case of be careful what you wish for a little bit with that. We don't expect the Fed to cut more aggressively without a good reason to. They don't want to be in a situation where with inflation picks back up because they've cut rates too quickly. They'd rather be too late than too early. And therefore, we think the market's getting a little bit ahead of itself from that perspective. In terms of what we're looking at in the markets right now, we retain a preference for quality in equities and investment grade in debt. With interest rates, at such elevated levels, we need to be investing in quality companies with good, strong balance sheets. They're going to perform. They're going to be able to swallow those higher interest rates when refinancing comes around. And same in the debt market. Refinancing on higher for longer rates, good quality companies, investment grade debt, going to be much more resilient in that space. Now, at the moment, interest coverage in high yield debt looks okay, but expect deviations in the fortunes of companies within that. There's going to be some that are going to be on high single digit multiples of interest rate coverage, and there's going to be others that are going to struggle a lot more. So if you're going to be looking at high yield, which we are marginally, it pays to be active in that space, and that's certainly what we're looking at. One final point, appreciate we're getting very close to time. 2024 is definitely a year of elections. The US going to be going to the polls in November. The UK has to go to the polls before the end of Jan 2025. But the first election we're going to see this year is actually in Taiwan, and that's this Saturday. And it's proving an interesting one from the perspective that the politicization of asset prices and of company behavior. So you've got TSMC, Taiwan Semiconductors. It makes up 25% of the Taiwanese stock market, but it's being dragged into that political conversation. And we think we could see that across more of the election cycle this year. This dragging in of and we've seen it already with China, and we saw it with the US, with tariffs and all this kind of thing. So things that are going to impact specifically on companies. And so this is something we need to watch out for when we look at the election cycle. Quickly on to dates for your diary this month. Firstly, central banks meetings a little bit more sporadic through the first quarter, potentially even into the second quarter. Towards the end of last year, we get used to this monthly cycle of meetings. They're going to be a little bit more spread out in the first half of the year, and that's probably not a bad thing because it gives central banks a bit more time to consider their moves. 11th of January, US inflation. Expect headline to stay static at around 3.1, potentially even slightly tick up to 3.2, but stay in that region. Core inflation. This is where we strip out those volatile aspects and focuses more on services inflation. Expect that to come off a little from 4% just down to 3.9, 3.8, some sort of tick down to prove that consumer services consumption is coming off. 17th of January, UK inflation, a little early for full consensus yet, but we're not expecting much of a move. This expect it to stay steady. Obviously, the market will welcome any fall in that. 25th of January, ECB interest rate decision. So the first of the three, ECB and Federal Reserve and Bank of England, none of which are expected to move this month. So we've got the 25th of Jan for the ECB, 31st of Jan for the Fed, and 1st of Feb for the Bank of England. Expect no movement. So that'll be a fourth meeting in a row with no movements across any of those. I'll stop there. Obviously, if there's any other questions, either about what we've talked about today, any of the questions that you're getting from your clients about 2024, please feel free to get in touch with us. And apologies, we've run over a little bit, but yeah, I hope that's been a sort of whistle-stop tour of what we see going on in markets in the coming months and even further into the year.
Thank you very much, Gareth, and thank you, everyone. Enjoy the rest of your weeks. And as Gareth has said, please do let us know if you'd like to contact us on any of the content. Thank you very much, and bye for now.